Hello, everyone. Welcome back to another episode of Signal or Noise. This is episode 43. Charlie Bilello here, and with me, as always, Peter Mallouk. Two topics today, Peter. One, 5 lessons from Peter Lynch, and 2, we're going to end with Signal or Noise, talking about tariffs, trade wars, and all of that good stuff. So I want to dig right in. 5 lessons from Peter Lynch. Needs no introduction. We'll talk about his career within these 5 lessons. Let's go to number 1 here. Know what you own. And here's the quote that I often use. Know what you own and know why you own it. This is so important for every investor. Education is an edge. And I know at Creative Planning, this is huge, Peter. Every client that you talk to, we're talking about why you own stocks, why you own bonds, why you have some cash in your portfolio. But I think this chart really illustrates it looking at the last 30 years. You own stocks for long-term growth. You can see S&P 500 up 1,400 plus percent. You own bonds to meet your short-term needs. Your return expectations should be lower, up around 228%. And you want to be an investor because of this constant threat of inflation. We know it's going to be there. We just don't know the exact number. Prices have more than doubled in the last 30 years. So when you're talking to investors, often they'll ask, well, why do I have this in my portfolio? What's the purpose there? How do you approach that with investors? How do you explain and make them know what they own and why they own it?
Yeah, I think that's the key, is saying, well, stocks are great now, or bonds are great now, or this private equity fund looks interesting, is very different than saying, hey, here's how much money I may need in the next 5 years. Here's how much money I may need 10 years from now. Here's this money I don't need for another 15. Or here's how I feel about volatility, or how nervous I get when the market is down. You really want everything to be goal oriented. Like, what am I trying to do and what do I have to do to make that happen? And you go backwards into the investment. The why begins with you, not the markets, not the security. And then you need to know, like, what is the content of what I'm going to put my portfolio together with? Is this high? Do I expect high performance here? Why do I expect high performance? What is it about these stocks, these bonds, these private funds that's going to help propel me where I want to go? But you've got to begin with you. The why begins with you, and you go backwards from there.
So if stocks only went up, there would be no need to own anything else, right? That's often the question. Why do I even need bonds? And you always talk about meeting short-term needs, and that's 100% true. But there's also these periods where stocks actually go down, and you have a negative return for the market. You have a bear market. And a lot of that time, if you look historically, bonds have kind of cushioned the blow. Now, 2022 didn't do a great job of it because bond yields were at all-time lows. But if you look at these other years since 1976, when the S&P 500 has been down, bonds have been up. And the value of that in a portfolio, Peter, as you often talk about, is because then you have this opportunity to opportunistically rebalance and using that decline to be proactive and take money out of the bond portion of your portfolio and add it to stocks when they're cheaper.
Yeah, there's only 3 reasons to own bonds. One is you believe bonds will do better than other investments going forward. There are some people that believe that. Oh, the market's really high, private investments are really high, real estate's really high. All of these things will have negative returns for the next 10 years or very low returns. Therefore, I'm going to own bonds. This is a very small group of people. I'm definitely not in them. History says these people tend to lose almost all of the time, but that would be reason number 1. Reason number 2 is you might need money the next 5 years. And no matter how great the world is, no matter how fantastic you think everything may turn out, no matter how confident you are in what you're buying, if there's a COVID or a 9/11 or an 08 or 09, probably going down, right? If you're an owner of stocks, real estate, private equity, you're probably going to see declines. So if you're making withdrawals during those declines, you can have permanent problems. So you need bonds for that reason. And the third reason is you just don't want the volatility. And there's nothing wrong with that, by the way. There's people that go, look, I'm on track to be where I want to get, or I'm already there. I don't need this drama. I don't need my portfolio to go down 45, 55% every 5 years when there's a bear market. I'm going to put 30, 40, 50% more in bonds, and I'm just not going to deal with the drama. And I don't care if the probability that I'm going to earn is higher, that I'm going to earn 2 or 3% less over a decade. Those are the 3 reasons. Make sure you know your why, and then back into the investments.
Right. So it comes down at the end of the day to an allocation, and this is just simply looking at the split between stocks and bonds. And there's a trade off, as you can see in this chart here. The higher the risk on a long term basis, the higher the reward. Stocks don't give you that 10% long term return without higher risk of drawdown, higher volatility along the way. And for every investor, there's a right place in the spectrum. But it might not be. I know a lot of advisors just use simply age, Peter, and other factors like that. I know you don't believe in this. For everyone, it's unique. Someone might be 75 and have a very high risk tolerance, have no interest in owning a lot of bonds, and someone might be 25 and have a different view and say, "I want sleeping at night is a premium to me. I want
Right.
to hold more Treasury bills and bonds."
100%. And I think there's nothing wrong with getting there by sleeping at night. Doing it based on your age, as you mentioned, or anything related to, well, I'm at this point in my life, I therefore should have bought this much bonds. I don't think that's the right way to do it. You have two people are 60, two people are 30, have very different needs, very different savings rates, very different future withdrawal rates. They should have different allocations.
Absolutely. But the key of all of this is know what you own and why you own it. And the reason you want to do that is because things don't always go up. And when they go down, well, if you don't know what you own and why you own it, well, you're likely to abandon that. And many of these other lessons deal with that. So we'll touch on that. But let's go to lesson number 2 here. Don't try to time the market. And this is a quote I've used many times in the past. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. Now, Peter, we haven't had a correction here since last August. Seems like a distant memory at this point. That's a pretty long time. Usually you get, 3 to 4 corrections a year. We know another one's coming. You could kind of fill in the blank. Let's say if one were to happen now, we'll talk about tariffs later, but you could probably say that would be one reason assigned to it. But investors should be fully expecting that correction to come. And there's many cases you can make. Stocks are highly valued, and we have this trade war. We have all this uncertainty, on and on and on. Why shouldn't an investor think about now trying to time the market and buy back in at a lower price?
I mean, the issue is that this thinking begins with this idea that the market goes up and down, and therefore I'll wait till it's down and then I'll add and then it'll go up. That's not really what the market does. The market over a long period of time goes up, and it has intermittent breaks where it goes down. So it's very common for, say, the Dow to use one index to go from 35,000 to 37,000, then go backwards to 36, but never revisit 35, right? If you're on the sideline, the market can get away from you. That's what's basically happened to everybody since COVID. Everybody waiting for this pullback that they can get back in have permanently missed an opportunity. I mean, it's real wealth destruction by being on the sidelines during any of this. And so stop trying to avoid the next correction. That one happens about every 13, 14 months. Average correction's about 14%. The next correction that happens, I bet it'll happen this year, just statistically, it's going to be a drop of 6,000 points, and everyone's going to lose their minds, but it's something that happens all of the time. Just keep buying, keep buying, keep buying through the whole thing.
Yeah, to your point here, we don't know which of these numbers won't be revisited ever again. So if you're waiting for that particular number and you got out because of any of these reasons, whether it was the Greece default, I mean, a lot of these things you just quickly forget about. Fed tapering back in 2014 seems crazy that anyone would have gotten out of the market, but back then it was real and it was visceral, and people were
Yep.
saying a lot of negative things to get people out of the market. But the question often arises, though, Peter. Okay, maybe I can't do this myself, but shouldn't a professional who's been doing this all day, every day, and really promising that as their strategy to get in and out of the market and shift allocations, based on this market time, shouldn't they be able to do it better for me? And unfortunately, the answer overwhelmingly is no. Morningstar just came out with another study of the tactical allocation category here. And what they found, if you look at 1 year, 3 years, 5 years, 10 years, 15 years, 20 years, every single time period, Peter, massive, massive underperformance. If you look at the last 15 years, 60-40 return, 9.3% per year, pretty good period for 60-40. The tactical allocation, this is an average 5.4% per year. And many of them performed far worse than that. And I think of the funds that were around 15 years ago, more than 3/4 of them are no longer around today. So why is it the case that even professionals have such a hard time timing the markets?
Because market timing doesn't work. And it's not market timing doesn't work for retail investors. It doesn't work for anybody. The market is too dynamic. Like, think about today. We've got change in regulations. We got a tariff war with Canada, China, Europe. You've got change in immigration policy. We don't know what's going to happen with geopolitics in Ukraine, Israel, Gaza. With corporate taxes are on the table. They're talking about abolishing the income tax rate. All of these things are in play right now. And think about, most corrections are things we're not thinking about. It's just something new that shows up. Like COVID's the new classic example, but it could be anything, right? It's this idea that I'm going to go on the sideline and wait for this issue to resolve itself and come back. Well, it's not one issue. It's 100 issues plus invisible issues. And no one can see the invisible issues or get the dynamics right of everything else.
So you can't build a strategy based on the past, because every environment is different and it's constantly evolving. So we shouldn't expect them to crunch all of this data and say, well, this is how the market reacted when XYZ happened in the past. Well, no, today is different for all the reasons you mentioned. And just to illustrate this crazy point here in terms of doing nothing is often better than taking action, Morningstar did another study looking at these allocation funds over a 10-year period. And what they actually found, Peter, was that if they just held their beginning allocation, like whatever they started out with in 2013, and didn't do anything, didn't like literally nothing, that they all would have done better than doing the series of trade. Every single fund, and I think 4.6% per year, they're saying more of a return had they done absolutely nothing. That's kind of shocking, at least to me.
Yeah, I'm not sure it's shocking to me. I think the tactical allocators tend to also sit on cash at times. And so when you have money sitting in cash, market's got an upward bias, you are really swimming against the tide. And so I think that that's probably a big factor here, combined with these are human strategies and humans have emotions. They make the same mistakes everybody else does.
Right. And this wasn't a period, Peter, without any volatility or corrections, right? You had 3 bear markets. You had one in 2018. You had obviously the COVID crash in 2020, and then 2022 was a longer bear market. So there were opportunities, let's say, if you had this ability to time the market, there were opportunities for them to be able to, let's say, get out before and then buy back in and add value. It just, they weren't able to do it. And really, historically, no one's been able to do that repeatedly over the long run. Let's go to lesson number 3 here. There will be drawdowns. I got 2 quotes here. The key to making money in stocks is not to get scared out of them. And the second one here, you get recessions, you have stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in the markets. I want to start out here talking about the group of stocks I call the enormous 8. And I just add Netflix to the Mag 7 to include it here. What I'm showing here, Peter, are the eye-popping returns on the right side. You got Google is the worst performer of the group, up 660% over the last 10 years. And you got Tesla and NVIDIA. You got these massive, massive returns across the board. But that didn't come without risk. You have enormous risk along the way. And the left side tells the story. Huge, huge drawdowns across the board. Shouldn't every investor kind of understand this, that there's no upside without that downside, and you have to be able to stick with these huge declines in order to make those big rewards?
Yeah, and a great investor loves the downside, because the downside's the thing that drives people out of equities and makes bonds attractive. We need to have a bond market for the stock market to do so well. And if there was no risk with stocks, the returns would be much lower. And so it's the volatility that's really the number one thing that's paying the investor. is the
Yeah,
willingness to take on this volatility.
absolutely. And it's not easy, right, to sit through it, which is why most people would be much more likely to stick with a diversified portfolio, because losing 70, 80% of your money in a stock and being concentrated on there, how many people are going to stick with that? We know from history, Amazon and many other examples where they've had 90+% declines. And think about if you have all of your money that you've saved in that stock, it goes down 90%. Almost no one's just going to sit there and take it. So if we're looking at bear markets here, Peter, this is a table going back to the Great Depression, looking at bear markets here. And he's saying you have to kind of accept it in terms of if you're an investor for 30 years, right, and there's a bear market every 4 years on average, you should expect many, many of these big declines. And if you're not ready to accept that going in, well, then how in the world are you going to stick with it when it actually comes?
100%. Go in, eyes wide open, corrections every year on average, bear markets every 5 to 6 years on average. They don't space themselves out nicely. Good investors can hold through all of that. Bad investors panic and sell. Great investors love it. They embrace it.
Absolutely. Let's go to lesson number 4. Keep it simple. Never invest in any idea you can't illustrate with a crayon. And this is a hard one for many investors to understand because complexity just sounds better. It sounds like adding complexity should give you a higher level of return. And here I'm just highlighting hedge funds, equity hedge funds versus a simple 60/40. And they're doing many of them complicated strategies that most of their investors probably don't have a great understanding of, to say the least. And you can see here over the last 15 years what a simple 60/40, just S&P 500 and aggregate bond fund would have done 280% versus the average equity hedge index here up 106%. I know this stat isn't surprising to you, but how do you explain to the average investor why simpler is not only better for them actually in terms of returns, but getting back to that know what you own and why you own it concept, that when you have these big drawdowns, well, you can understand why stocks are down or why bonds are down in your portfolio. Much harder when you have these complicated investments and funds where there's really very little transparency in terms of what they're doing.
Yeah, Warren Buffett's a big fan, along with what you referenced, Peter Lynch, on this simplicity concept. If you can't understand it very clearly, someone can't articulate it very clearly, don't invest in it. I mean, Enron's the classic example of that. There's many, many, many companies that have gone under where no one really knew, and then explain it, and you're like, well, I don't really get it. This is why I'm not a fan of things that are very derivative, like an investment that's a derivative of something else that's a derivative of something else. Because even if you understand the little investment itself, you don't understand the repercussions of if a butterfly flies in Mongolia the wrong way, what happens to this hedge fund over here, right? All of the dominoes that start to fall that impact things. We saw that in 0809, where a lot of different investments performed very poorly, and they were for reasons that were unanticipated because the products were structured or derivatives. In other words, it wasn't a pure stock or a pure bond. It was something that was tied to something else in some way. This is the reason I don't like those things.
Yep. Let's go to lesson number 5. And this is a really interesting one, knowing when to walk away. He talks about one of the reasons I left Magellan was that I wanted to retire while I still had a good record. I left the party when the cake and the champagne were still being served. And this is just highlighting his track record, really an anomaly, right, in the industry where he not only did very well, and he certainly most of the outperformance came in the early years when the fund was very small and no one was in the fund. But even the last 5 years when it was already the biggest fund in the world, he still outperformed by I think 5 or 6% per year. And during the entire period here, May 1997 to May 1990, 1977 to 1990, 29% annualized versus 15 for the S&P 500. And there's some parallels here, Peter, to sports. If you think about Jim Brown or Barry Sanders retiring after just 10 years in the league, and I often think about Jerry Seinfeld, and he's done some great interviews on that. Why did he only do 10 seasons? Really left on top. What do you make of this ability? It's got to be very hard, obviously, right? You're the king of the world here. the most well-known, probably fund manager, or at least one of them of all time, and he's walking away. And then we'll talk about the reasons why he was saying he needed to leave at that
I
point.
think of Seinfeld, like you referenced, when I think of this quote about like you said, he wanted to go out on top, or like you said, Brady. What's interesting though is it implies that Peter Lynch thinks he doesn't control it, right? That he recognizes that for all his brilliance, at a time where there was not really internet for most of the time, that was high speed, the market wasn't as efficient, he outperformed dramatically. But saying, "Hey, I'm walking away while I'm on top," implies that he may not stay on top, right? That it wasn't a repeatable, something that was easily repeatable. And I think that's saying something from a greater investor of that time.
Yeah, absolutely. And in terms of his reasoning here, he talks about, I'm missing so much of it. I went to a soccer game with one of my daughters, and I think they lost 7-0, and I had a great time. I went to one soccer game, I missed seven. And then this is from an interview a few years ago, I think in 2021. They asked him, "Do you regret stepping away?" He says, I don't keep score. I've got 10 grandchildren. That's what I keep score on." So he really went away to do things that he wanted to do. He was still investing for his family. He was still a mentor to many people at Fidelity where he worked. He still actively researched stocks. But to him, Peter, it was either 100 plus percent or nothing. He said he only had two gears, and the gear was 80 hours a week, where he started working all day, Saturday and Sunday, and missing everything else in his life, or nothing. He couldn't do the in between. He had
Tom
to
Brady,
be.
Tom Brady again, right?
There you go. Right. And sometimes it's very hard to switch off that gear when you get to that level. But I think he did it for the right reasons here.
This reminds me of the Kobe Bryant. When they asked him, "What do you do before practice?" And he said, "Practice." And he would show up 2 hours before he had practice before practice. These people that are operating at that level, the dedication, uh, that they're having to say no to a lot of other things.
Yeah, absolutely. All right, there you go. Peter Lynch, 5 lessons, many more we could do. If you're watching this and you're thinking about tax season coming up, thinking we have over 300 CPAs at Creative Planning, helping people prepare taxes and also working with wealth managers to minimize the taxes you pay and maximize the return. So reach out today, creativeplanning.com/Charlie. You're going to get a free wealth path analysis when you schedule a call or a meeting with an advisor. We're at all 50 states at Creative Planning. We likely have a location right near you. Over 345 billion in assets under management and advisement. We're here to help. Reach out today, creativeplanning.com/Charlie. Okay, Peter, let's go to Signal or Noise. I know you've been doing some interviews about the tariff situation. I first have to say it's kind of hilarious. The last two Sundays, we have pretty much deja vu, right? Futures are down. Media's putting out all of this negative headlines. Market's going to crash because of tariffs and trade wars. And literally 24 hours later, Colombia caves. A deal is reached. There's no tariff there. They accept the prisoners who were put on a plane. They accept them back to their country. And I think the president actually offered his own plane. And then a week later, you have Canada and Mexico, similar situation, negotiations about the border, how to secure it, and how to prevent drugs from coming through it. Initially, they're saying, "Oh, this is going to lead to a long and drawn out trade off," and then 24 hours later, both of them agree to take measures at the border. I think they said that Mexico was going to send 10,000 of their troops to try to stop the flow of fentanyl across the border. So we had talked about this earlier in terms of it's being used obviously here as a policy tool, as leverage, right, to enact this policy. But so much noise is out there in terms of, well, what will this actually mean? And there's people making estimations, right? What hit to GDP, hit inflation. To me, it just seems like all of that is impossible to predict because of just the uncertainty of you could have a deal 24 hours later that changes everything.
Yeah, I think the stock market doesn't believe about the permanence of any of these tariffs, right? I mean, it's literally barely moved. If we really believed there was going to be 25% tariffs on Mexico and Canada, and then same on China, and we're going to get a tariff war with Europe, and the market believed it was going to go on for 6 months to a year, the market would go down 10 to 20%. There's very little question about it. Market doesn't believe it. It believes we're going to have a little bit of a trade war. Trump's going to get concessions, and we're all going to move on. Now, the market could be wrong, right? It could be, we could have an unintended consequence. Things could get more serious. Who knows? But the market just doesn't buy it. It's expecting what we're seeing. Trump saying, "Hey, we're going to do this," and then there's a quick compromise. Trump administration posts some sort of win. Colombia is taking back some people that came from Colombia, and Canada is enforcing the border more, and Mexico is putting troops on the border and blocking fentanyl and all. And he posts his win, and then things pause. So we don't really know where it's going to go, but the market's not buying it.
Yeah, that seems to be the case. What's interesting to me, Peter, is how we didn't hear really anything about tariffs under the 4 years under Biden, but the amount that we collected under Biden was actually more than under Trump. So he actually added additional tariffs, mostly on against China, and there was not a single word about it. And the other thing is dealing with markets is the stock market did very well. We know under Trump's first term, regardless of those tariffs, it did very well under Biden's term. So this notion that automatically this is going to be bad for stocks, bad for earnings, bad for the U.S. economy, it's not 100% clear to me. It seems to be a negotiation strategy, and every country is doing this. I think it's kind of the media is kind of portraying it as just the U.S. is the only one in history to ever put tariffs on anyone. When you look at all of these countries around the world, you see some of them do broad 20% tariffs, and they don't have high inflation. You have many different examples, and obviously the situation with China being the most complex, right? Because they're not accepting many of our goods into their country. We know the situation there is very complicated. We know that we want to have some independence in certain industries. So it's not even clear cut. Like, should we have no tariffs with anyone? That doesn't seem to make sense. It's really about getting to a place of fair trade versus this idea of just free trade is always good. Is that how you're thinking about this situation?
I think I mostly agree. I think there's a couple different things with Trump. One, extremely vocal about it. Second, very high tariffs without a demand that accompanies them, right? Which is a negotiating tactic, right? But that's what's different here from the way that the Biden administration implemented a bunch of tariffs on a bunch of countries, over time. This is much less thoughtful tariffs on specific things and much more economic war, right? But that's what Biden wanted and what he was trying to do. And this is what Trump wants. And he's trying to do something very different. So it's not a political statement. I think they're taking different approaches than maybe the graph is illustrating.
Right. Okay. And just going to the markets here, I just want to highlight the S&P 500. Go back to that chart of S&P 500 corrections. And we go back to 2018 when that first trade war, it was really concentrated with just China back then. And where the S&P 500 was back then, Peter, 2,900 before it, we know we're at 6,000 now. So the S&P 500 is doubled despite all of this. And if you let that noise really impact your long-term investing at that point in time, would have been a very bad move. I think that's the broader message. It's not that there won't be a correction and they won't blame it on tariffs, but my bigger point is it's absolutely impossible to say, is this good, is this bad, like just generally saying it's good or bad. And then when you have the deals literally changing everything 24 hours later, all of those assumptions that you're making based on, were we really going to have 25% tariffs on Mexico for 10, 20 years? Almost impossible, but people were talking and acting as if they were. So my take is simply, if you're going to look at tariffs, take a bigger picture and really dig into the actual details of what countries are doing to us, what we're doing to them, what has happened historically. It's not as simplistic as simply tariff is always bad in all cases. Okay, but I think that's a good place to end. If you're watching this on YouTube, everyone hit that subscribe button for more content just like it, and we'll see you next time on Signal or Noise.